Strategies for effective liquidity management in banks. In today's financial landscape, effective liquidity management is crucial for banks to ensure stability, meet regulatory requirements, and support economic growth. Let's delve into strategies that can enhance liquidity management within banking institutions. Understanding liquidity management. Liquidity management in banks involves the ability to meet cash and collateral obligations without incurring unacceptable losses. This balance is vital for operational integrity and customer trust. Key strategies for liquidity management. Maintaining a diverse asset portfolio. To manage liquidity effectively, banks should diversify their asset portfolios. This involves holding a mix of short-term liquid assets and longer-term investments. By doing so, banks can ensure they have readily available funds to meet immediate obligations, while also seeking higher returns from longer-term investments. Implementing strong cash flow forecasting. Accurate cash flow forecasting is essential. By predicting future cash flows, banks can anticipate liquidity needs and adjust their strategies accordingly. This includes analyzing trends in deposit withdrawals, loan repayments, and understanding the impact of external economic factors on liquidity. Liquidity buffer creation. Regulatory bodies often require banks to maintain a liquidity buffer. This buffer, consisting of high-quality liquid assets, HQLAs, helps banks survive financial stress scenarios for a set period. The size and composition of the liquidity buffer should be based on the bank's specific operational needs and risk exposure. Active liability management. Liability management involves managing the bank's liabilities, such as deposits, in a way that supports liquidity. This includes offering competitive interest rates to attract stable deposits and creating products that encourage longer-term deposits. Maintaining a healthy balance between demand deposits and time deposits is also vital. Stress testing and contingency planning. Banks must regularly conduct stress tests to assess their liquidity position under various adverse scenarios. These tests help identify potential vulnerabilities and enable the development of effective contingency plans. A robust contingency funding plan, CFP, outlines specific actions to be taken in response to liquidity crises, including accessing additional funding sources. Establishing relationships with central banks and other financial institutions. Building strong relationships with central banks and other financial institutions can provide additional avenues for liquidity support. These relationships enable banks to access central bank funding facilities and interbank lending markets, which can be crucial during periods of liquidity strain. Using advanced technologies. Innovative technologies, such as artificial intelligence and machine learning, can significantly enhance liquidity management. These tools allow for real-time monitoring of liquidity positions, sophisticated cash flow forecasting, and automated stress testing. Monitoring and reporting. Continuous monitoring of liquidity indicators and metrics is critical. Effective reporting mechanisms ensure that bank management and regulatory bodies have a clear understanding of the bank's liquidity position. This transparency aids in decision-making and regulatory compliance. Employee training and awareness. Lastly, cultivating a culture of liquidity awareness among employees at all levels is fundamental. Staff should be trained on liquidity risk management practices and understand their role in maintaining liquidity. Conclusion. In conclusion, managing liquidity is a dynamic and complex challenge that requires a strategic approach. By diversifying assets, forecasting cash flows, establishing liquidity buffers, and leveraging technology, banks can navigate the uncertainties of the financial market. Want to learn more? Claire Trifle on LinkedIn.